Today, we will talk about expense ratio, definition, formula, components, example. The expense ratio measures how much of a fund's assets are used for administrative and other operating expenses. For investors, the expense ratio is deducted from the fund's gross return and paid to the fund manager. Operating expenses vary according to the fund or stock, however, the expenses within the fund remain relatively stable. For example, a fund with low expenses will generally continue to have low expenses. The largest component of operating expenses is the fee paid to a fund's investment manager or advisor. The expense ratio is calculated by dividing a fund's operating expenses by the average dollar value of its assets under management. Operating expenses reduce the fund's assets, thereby reducing the return to investors. Most expenses within a fund are variable, however, the variable expenses are fixed within the fund. For example, a fee consuming 0.5% of the fund's assets will always consume 0.5% of the assets regardless of how it varies. In addition to the management fees associated with a fund, some funds have an advertising and promotion expense referred to as a 12b-1 fee, which is included in operating expenses. The expense ratios of an index fund and an actively managed fund often differ significantly. Index funds, which are passively managed funds, typically carry very low expense ratios. The managers of these funds are generally replicating a given index. Actively managed funds employ teams of research analysts examining companies as potential investments. Those additional costs are passed on to shareholders in the form of higher expense ratios. Passively managed funds, such as index funds, have much lower expense ratios than actively managed funds. For example, a hypothetical actively managed fund may have an expense ratio of 1.5%, and a hypothetical index fund may have an expense ratio of 0.05%. After accounting for the expense ratios, the net returns for investors are impacted. Mutual funds charge management fees to cover their operating costs, such as hiring and retaining investment advisors, as well as other operating fees like marketing, legal, auditing, and customer service among others. These fees, along with the cost of hiring managers, make up the fund's expense ratio. The expense ratio refers to how much of a fund's assets are used towards administrative and other operating expenses. Because an expense ratio reduces a fund's assets, it reduces the returns investors receive. Mutual funds that invest in large companies should not have an expense ratio above 1%, while funds that invest in smaller companies should not have an expense ratio above 1.25%. However, it's important to note that funds with expense ratios higher than this may provide a special service justifying their high cost. Expense ratios are taken out of mutual fund and ETF returns to help pay for operations and fund management. In general, expense ratios have been declining steadily over time as competition for investor dollars has heightened. Actively managed funds and those in less liquid asset classes will tend to have higher expense ratios, while passively managed index funds feature the lowest expense ratios. Here are 4 key takeaways. 1. The expense ratio measures how much of a fund's assets are used towards administrative and operating expenses. 2. Investors should pay attention to the expense ratio to determine if a fund is an appropriate investment for them after fees are considered. 3. Passive index funds will have lower expense ratios than actively managed funds or funds in less liquid asset classes. 4. In general, funds' expense ratios have been declining over the past several years. Hope this would help. Thanks for watching.